You're listening to HECM World Weekly, the nation's only weekly podcast bringing reverse mortgage news to you, the mortgage professional. There are reverse mortgage calculators, but then there are reverse mortgage point-of-sale solutions. Lenderful Solutions helps you get more loans, retain more customers, and even make online applications a reality. To learn more, visit lenderfulsolutions.com.
Hello, and welcome to another edition of HECM World Weekly. I'm Gabrielle Hayen. This week, we're talking about inflation, retirement, and one theme that connects every major story that we've been following: housing wealth. The headlines range from cooler inflation and mortgage rates to Social Security, retirement confidence, aging in place, and the great wealth transfer. But perhaps the most interesting development came from outside the mortgage industry altogether. This week, the New York Times argued that America doesn't simply have a housing crisis. It has a retirement crisis hiding inside a housing crisis. For those of us in the reverse mortgage industry, that's a conversation we've been having for years. Let's start with this week's biggest economic story. The biggest news this week came from the latest inflation report. June's consumer price index came in softer than expected, surprising financial markets and dramatically reducing expectations that the Federal Reserve will raise interest rates later this month. Headline inflation slowed to 3.5%, while core inflation cooled to 2.6%. Treasury yields immediately moved lower, and markets quickly shifted from worrying about another rate hike to expecting the Fed to leave rates unchanged. Now, it's important to remember that 1 month doesn't establish a trend. Federal Reserve officials have been very clear that they want to see several consecutive months of cooling inflation before declaring victory. But after months of uncertainty, this is the first report that's genuinely giving housing markets some breathing room. Mortgage rates have been hovering around 6.5% for weeks, frustrating buyers and keeping many homeowners locked into the historically low mortgages that they secured during the pandemic. If inflation continues cooling, Treasury yields could remain under pressure and mortgage rates may gradually improve as we move through the second half of the year. For the reverse mortgage industry, that's particularly important because interest rates directly affect HECM principal limits. Lower rates generally allow borrowers to access more of their home equity, making reverse mortgages more attractive for many homeowners. So while one report won't change the market overnight, it finally gives lenders and borrowers something they haven't had for quite some time: a genuine reason for cautious optimism. In industry news, the latest HECM TPO broker report was also released on HECMWorld.com this week. Atlantic Avenue Mortgage continues to lead the broker channel after another standout month, recording 110 endorsements in April. That's well above its monthly average and lifts its rolling 12-month total to 978 endorsements, further extending its lead. Loan Depot remains comfortably in second with 456 endorsements over the trailing year after adding another 43 loans during April. Caliber Beach Mortgage holds third with 393, while C2 Financial rounds out at the top 4. West Capital Lending climbed to 5th place, and Barrett Financial Group also had a strong month, adding 19 loans to push its rolling total to 134. As always, the report uses trailing 12-month endorsement data from Reverse Market Insight, providing a useful snapshot of activity across the HECM broker and third-party origination channel. Meanwhile, new research is showing that retirees can expect a big Social Security increase next year. But will it really have an impact? AARP is now projecting a 3.6% Social Security cost of living adjustment for 2027. If that projection holds, it would increase the average monthly benefit by around $75 and represent one of the largest COLAs in nearly 5 years. On the surface, that's good news. Millions of retirees depend on Social Security as their primary source of inflation-protected income. But the bigger picture is more complicated. Housing costs continue rising. Property taxes remain elevated in many markets. Insurance premiums have climbed dramatically, and healthcare costs continue increasing. Many retirees are also helping spouses, children, or even grandchildren financially. So while another meaningful COLA certainly helps preserve purchasing power, it's unlikely to fully close the gap facing many households living on fixed incomes. That's becoming one of retirement's biggest challenges. Social Security remains the foundation, but for many Americans, it can no longer carry the entire weight of retirement on its own. That idea was reinforced by a fascinating new survey from Thrivent. At first glance, the results appear encouraging. Nearly 3 in 5 Americans say they remain confident they'll have enough money to retire on schedule. But when you dig deeper, the picture changes dramatically. Almost half of non-retirees don't believe they'll ever fully retire. More than 1/3 expect they'll continue earning income after leaving their primary career. Nearly 2/3 admit they're more focused on paying today's bills than preparing for retirement. Inflation remains the biggest concern. But what surprised me was another issue appearing in this year's research: artificial intelligence. Nearly 2/3 of Generation Z respondents and almost 6 in 10 millennials believe AI could negatively affect their retirement prospects by reducing future job opportunities. Even today's retirees are becoming increasingly concerned about inflation, political uncertainty, and broader economic conditions. Perhaps the biggest takeaway isn't any single statistic. It's that retirement itself is changing. For many Americans, retirement is no longer viewed as a finish line. It's becoming a gradual transition where work, savings, Social Security, and housing wealth all play a role. That's exactly why conversations around home equity are becoming part of a broader retirement plan. For years, we've heard about the great wealth transfer as though it were something waiting to happen. This week's Visa research suggests it's already underway. The firm estimates around $36 trillion will transfer from baby boomers to younger generations over the next 20 years. But what's really interesting isn't the number. It's when families are choosing to share that wealth. 1 in 4 millennial homeowners already received financial help from parents towards buying their home. More than a quarter say they simply couldn't have purchased without that assistance. And 2/3 of boomers say they'd rather enjoy their wealth or watch their families enjoy it while they're still alive than leave it all as an inheritance. That's a significant cultural shift. Housing wealth is becoming a family resource rather than simply an individual asset. Parents are helping children buy homes, grandparents are helping grandchildren, and financial decisions are becoming increasingly intergenerational. For reverse mortgage professionals, that's important because home equity conversations increasingly involve adult children, financial advisors, and estate planning rather than just the borrower sitting across the table. The great wealth transfer isn't simply changing who receives wealth. It's changing when families choose to use it. One of the strongest research papers this week actually came from healthcare rather than housing. Researchers studying more than 7.3 million older Americans found that states investing more heavily in home and community-based services help significantly more seniors remain living independently in their own homes while reducing moves into institutional care. That's an important finding because it reinforces something our industry has understood for years. Most older Americans don't want to leave their homes. They want to age in place. But aging in place isn't free. It often requires home modifications, maintenance, caregiving, healthcare, and financial flexibility. As governments increasingly invest in helping older adults remain at home, the financial conversation naturally shifts towards how that independence is funded. That's where housing wealth increasingly becomes part of retirement planning rather than simply part of home ownership. Finally, I want to finish with a story that stood out this week. A New York Times opinion piece argued that while America certainly has a housing crisis, hiding inside it is a retirement crisis. The author writes that a home has stopped being simply a place to live. Instead, it becomes an asset that has to appreciate in value to underwrite retirement. She then makes another observation that really caught my attention. The house can't do 2 contradictory jobs at once. Older homeowners need rising home prices to help fund retirement. Younger buyers need housing to become more affordable. Whether you agree with her proposed solution isn't really the point. The important thing is that one of America's most influential newspapers is now framing housing wealth as a retirement issue rather than simply a real estate issue. That's a conversation the reverse mortgage industry has been having for decades. The rest of America is beginning to have it too. Looking across this week's stories, one common thread keeps emerging. Inflation, Social Security, retirement confidence, the great wealth transfer, aging in place, even the New York Times, they're all pointing toward the same conclusion. Housing wealth is becoming one of retirement's most important financial resources. That doesn't mean every homeowner needs a reverse mortgage, but it does mean conversations around home equity are becoming central to retirement planning. And I think that's the biggest takeaway from this week. The reverse mortgage industry is becoming less about explaining a specialized loan product and more about helping older Americans integrate housing wealth into a comprehensive retirement strategy. Judging by this week's headlines, that's no longer just an industry conversation. It's becoming part of the national conversation about retirement itself. Thanks for joining me for another edition of HECM World Weekly. I'm Gabrielle Hayen, and we'll see you next week.